Good afternoon, everybody. Good morning for anybody that's joining us from the US. I'm proud to be the representative from the American Club of Brussels, which we are proudly celebrating our 100th anniversary of being the premier social club for American expats and any other expats in Brussels. I'm excited today to welcome Shannon Mayer, our newest corporate member and a longtime member of the American Club from some of his background in Brussels. Without further ado, I would like to introduce Shannon Mayer to start this conversation. Tell me a little bit about
Hi, Brian, and everyone else. Good to meet you.
Give us a little bit of a background on you. What's your Brussels connection?
Okay, so I spent over 20 years working with Deloitte & Touche, one of the big four accounting firms. And I was fortunate that 4 years of that, I guess it was 2008 through 2011, I lived in Brussels and worked in Deloitte's office out in Diegem at the time, and now they're located in Zaventem. So was very fortunate to live and work there for several years. And actually, pretty much since that time, I've continued to have a large, I guess, book of business and working with clients from Brussels or Greater Belgium in general. And one of the other great things about that is even after I relocated back to the US, then it gave me a basically company paid expenses and trips back to Belgium to see colleagues and visit clients there.
Maybe even have a good Belgian beer and a good Belgian waffle at different times.
That was usually factored in there too.
Brilliant. So your firm is back in the US, but it concentrates on American expats.
Yes. Yep. So kind of two pieces of my book of business. I work with, foreign nationals that have moved and are living in the US. And then I also work with US citizens living abroad, kind of all over the world, but pretty heavily in Europe and especially Belgium because of the knowledge of the tax systems I have there. About a year ago, so I spent most of my career with Deloitte, but about a year ago, kind of after living in kind of all different places, my wife and I decided it was time to get a little bit closer back to home. So we moved back to our home state of Nebraska, and I joined a couple of longtime friends to run our own CPA firm. So kind of out on my own now and enjoying working with expats around the globe.
Brilliant. And we'll make sure to send all the links and all the information in the follow-up email from this. We're going to get a little bit more personal, and then we'll get into the professional side. You spent some time in Belgium, and the American Club of Brussels this year is taking on the initiative of rediscovering Brussels. So Shannon, what are some of your favorite things in Brussels, apart from the beer? We've already covered that.
I would say one of my addictions, and this was for my whole family. So my wife and my eldest daughter was born there. We became addicted to the Liege Waffles. And as I'm sure many of you know that Belgium doesn't have all of the little ice cream shops or some of the things that the US has. It's waffle stands everywhere. So in order to still get our fix of that, when we moved back to Nebraska, my wife has started kind of a patisserie, because that was the other thing we became infatuated with was the Belgian patisseries. And one of her products that she makes is Belgian Liege waffles. So I was able to track down a waffle maker on eBay, kind of the authentic top of the line Belgian one. And she buys imported Belgian pearl sugar in 50-pound bags.
It's not easy to get, is it, in the States? I
No,
trying to buy some, and it was not easy to find.
Yeah, we found a distributor that has some, and then it literally comes in giant 50-pound bags. But yeah, and she makes authentic Liege waffles and sells them at the markets in our town.
Oh, that's brilliant. For those of you that are not as passionate about Belgian waffles as Shannon and I are, if you ever go to a waffle stand and you don't see that glazing on the outside, it's because they don't have the proper pearl sugar. They're just using regular types of sugar. And that's the part that makes them delicious and different and the distinctive Liège style. So that's impressive. Yep. That's given me reason to come over and visit you over in Nebraska to test these things out.
Yeah. The other thing that I came to love was speculoos, like the Biscoff cookies. So my wife actually makes she does homemade granola as well, and one of her flavors is a speculoos granola that she makes using the ground up Biscoff cookies.
Oh, Delicious. Okay. I'm going to need my afternoon coffee and, and sweets now. Well, naturally, we're here. It's just about to be tax season. So why don't we dig in a little bit about the tax season? And what are the main things that American expats should be thinking about in 2020 and 2021, especially in Belgium?
Okay. Well, the 20 tax laws, for your 20 tax return, a lot of it's going to be pretty similar as 2019. There wasn't any kind of sweeping reform like there was a few years ago. But one new piece that people are going to want to definitely keep an eye on is the COVID stimulus payments that were sent out. So if anybody received, a direct deposit or checks earlier in the year, there was one that was kind of issued in the May or summer timeframe, and then the second payments that came out in December. Those were really an advance payment of payment based upon 2020 income. So if you already got your full payment amount, you should be in good shape. But if you didn't receive the payments, you can still claim those through your 2020 tax return. It's called a rebate recovery credit. So if you haven't already gotten the money, you can certainly get those still. One thing to note though, is I've seen some clients, I'm sure you're all aware of how international postage works, and it's not super fast from the US. So if you had a check sent, before you just go and by default start claiming the credits on your return, the IRS has a website where you can kind of log in to check the status if they had sent a payment to you. Because I've seen some cases where checks were mailed clear back in October or September and just received in January. So there's a good possibility that the payment mailed in December or early January just hasn't even made it to you yet.
That's a brilliant point. I just got mine the other day, and the first thing I looked at was to make sure that it wasn't going to be canceled because it was over 90 days old. But at least it's not canceled until after a year. So you're all set there. For any of you that don't know where to deposit those, through our partnership with American Citizens Abroad, you can actually get an account over at the State Department Federal Credit Union if you're struggling at getting an American bank account to deposit that with, because naturally depositing that in your Belgian bank account might be either expensive or difficult next to impossible.
Yeah.
Any other things that we should be paying attention to this year?
I think looking for the future is probably going to be a big one, and kind of doing some planning around what might be happening. Anytime we've got a presidential change and the Congress change, tax reform is certainly always one of the topics. So although everything may be kind of set for 2020, you want to do some planning around what may happen in the future. And, it's all kind of based upon speculation and presidential campaign promises at this point. But essentially, the government has spent an amazing amount of money on economic stimulus aid that at some point in time, they're going to have to generate some tax revenue to pay for that. And current tax rates are at an all-time low. So I really don't picture taxes going anywhere but up in the future. Mostly probably targeted at more at the higher income levels. But that's kind of seems to be what the expectation is that we would be looking at some tax rate increases in the future.
Have you heard any rumblings of them changing the FEIE, the foreign earned income?
I have not heard on that. I think that one's probably pretty safe and stable. There was some debate about that in the last tax bill, but I wouldn't see that going anywhere. At least haven't heard anything.
So essentially, most American expats should be in the same position, no matter if they increase the tax base in the United States because of that credit or because of the rates that they're paying in Belgium.
Yeah, and exactly. And whether this is good or bad, I'll let you interpret. But even if they increase the tax rates in the US, they're still going to be plenty below the tax rates in Belgium on wages. So you're likely, if you are over the earned income exclusion limit, you're likely still going to have ample foreign tax credits to avoid a residual US tax.
Now, what about the estate taxes? There's a lot of rumblings right now in DC about changes in estate taxes.
Yeah, so on the estate tax side, there's, that was a topic of the discussion as well. So currently, if you're a U.S. citizen, and if you have non-citizen spouses, the rules work a little different there. So you'd want to make sure that you look into that, because the thresholds, exemption thresholds, are quite a bit lower. But currently for U.S. citizens, you've got an $11.7 million exemption for estate tax purposes. So it takes a pretty healthy size estate to start getting to the point where you're going to pay estate taxes in the U.S. They've talked about, so there's kind of twofold things that can happen, and this affects the income tax side as well. If Congress doesn't do anything, which is this was the same thing happened when President Obama was in. The Trump tax laws all had a sunset provision in them. So basically, as of 2025, the current tax system and rates expire, and everything goes back to the pre-2018 tax laws. So even if nothing, even if the government does nothing, the current rates and everything is going to expire and go back up to the pre-2018 rates. So on the income tax side, that means that we'd go back up to a top 39.6% tax rate. On the estate tax side, that means we would drop from an $11 million exemption back down to 5.4 million. So still a pretty good sized number, but cutting it about in half of what it is. The other debate there's also been kind of congressional Democrats pushing to further reduce that down to $3.5 million exemption. But that one, to go there, that would take basically a legislation being passed through Congress.
Exactly.
The other piece that they've talked about in estate tax is, so when you have your assets passed through your estate at death, you get a step up in basis to the current fair market value. And that's a huge benefit because, unlike Belgium, the US applies capital gains tax on your appreciation. So that's kind of a huge planning way to be able to avoid capital gains tax on appreciated assets. Goes through the estate, gets a step up in basis, and then it can be sold and you don't pay capital gains tax. There's been discussions about removing that step up in basis, but there's a lot of resistance to that as well. So I would be a little bit surprised if they're able to make that change. That's something that affects everybody, because it doesn't matter what your income level or your asset level is you get that step up in basis. So the things that continually, that the Democrats try to get pushed through is stuff that impacts the higher income. If it affects everybody, they shy away from it more.
There's a lot of exemptions in there, especially for farms and small businesses, et cetera, which seem to mimic more of the German rules to estate planning, where as long as it stays in the family, you get the reduced rate, but the minute you sell it, it would come back into the estate. So it seems like they're finally thinking it through versus the last 20 years of just saying increase it, no matter what market it should be. But with those strategies, do you find families gifting more right now to go ahead and usurp some of these rules that might change in the next couple of years?
I haven't seen that happen yet. I've had discussions with my clients about it, and I think we're all, for the next few years, everything is still good. I think you're going to see a lot of action kind of right before the law sunsets. If we don't see it being extended, or if they talk, the estate tax, even if they do get it passed, that's generally not something that's done retroactively. It's on a prospective basis, which gives some people time to plan. But yeah, for people that are over a $5 million estate, if it drops to that, you're probably going to see basically that last year some huge gifts to eat up that $11 million estate or exemption.
And just to remind everyone, in Belgium, we don't have a gift tax, whereas in America, if we gift, it just reduces over $15,000. It just reduces the amount that we give away in estate tax. So with Belgium, as long as you survive those 3 years, you don't pay anything, or you go down to the notaire and you pay a 3% tax, and you're able to gift that away to reduce your estate tax. So it's worth having those considerations in the next couple of years, and potentially talking to Shannon about those different opportunities that you might have.
Yeah, one big difference with the gift taxing versus estate taxing, if you make a gift while living, there's no step up in basis there. It's a carryover basis in the asset. So if you're going to be doing, if you're thinking about doing gifting and versus assets passing through the estate, it's pretty important to think about the specific assets that you want to give. You know, cash or assets that you don't really have any appreciation in. Those are the ones that you want to make a gift on because you're not concerned about the basis. If you've got highly appreciated assets, you know, maybe a house or something like that, those tend to be the ones that you might want to hold to pass through your estate so that you can get that basis step up.
Yeah, after 2020, you shouldn't really have too many assets that haven't appreciated much. It was definitely an interesting year, and otherwise you should be reviewing your portfolio for sure. Speaking of new taxes, we had a new wealth tax that was introduced in Belgium. Do you want to talk about that just a little bit?
Okay, yeah, and I know when Brian brought this up, I connected with one of my, I guess, former Deloitte colleagues in Belgium as well to make sure that I was on pace with everything, because I know it's been a little bit back and forth. So there was a 0.15% tax on kind of securities accounts over 500,000 euro that was passed or enacted in 2018. That actually got annulled by the Belgian court in I think it was October of 2019. So for 2020, I don't believe there should be a wealth tax in place. There is, though, currently legislation going through again about re-implementing it. They call it a solidarity tax, but it would be a 0.15% tax on like securities or assets over €1 million. So they upped the limit a little bit, but it's kind of going through the approval process. The effective date or when that would actually come into play, I don't know yet, but it is coming.
I think it's already gone into place for December 31st. So
oh, did it?
Yeah, it's any accounts that have started as of December 31st now are subject to it.
Okay.
And the funny, odd thing about this new tax is that they introduced it. Now, I probably shouldn't say this on a webinar, but it looks like they introduced it for the courts to throw it out again, because they introduced it stating that it's per account, not per household or per person. So in other words, if you have accounts at 5 different banks that are 800,000 apiece, you owe 0 in tax. But if you have all of that 4 million in one institution, you have to pay the entire tax. So it's designed either horribly or purposefully to be thrown out. I'm not going to make any accusations towards politicians on this segment. But
one thing to specifically know or to call out for Americans is wealth taxes are generally not a creditable tax for U.S. purposes because foreign tax credits have to be based upon the income, and a wealth tax is based on the assets, not income. So whereas you're claiming a foreign tax credit for all your Belgian taxes paid, this particular tax that if you're subject to that, it generally is going to be an itemized deduction, not a foreign tax credit.
That's a really good point, because yeah, it's where can you offset these types of things on that side. Many of our clients have literally just split some of their accounts to make sure that we reduce some of the different aspects of taxes. But for non-Americans, it's a little bit harder to shift some of those accounts because, well, the systems are not as efficient as they could be.
So one of the other things that people will want to look at is if they have a usufruct structure in place. Mm-hmm. Because, and I haven't dug into this, but I know from a Belgian perspective, but some clients I've had in other countries like Switzerland, for example, that does have a wealth tax, there can be some discrepancies, like when you have a usufruct where one person has kind of a remainder rights in the asset versus another person has the income rights. There gets to be an issue as to who's responsible for paying that wealth tax. So you could be in a situation where you may be subject to the wealth tax, but yet you don't own the assets, or maybe you're not generating any income from that to be able to pay that tax. So that's something that if you've got a usufruct structure in place, be sure to look into it to make sure that all the pieces of the puzzle are going to align.
Exactly, because it can be nice because maybe you have mom and dad and 2 kids on there, so now you have 4 owners of the overall bit, so you get an exemption because it acts just like a partnership in those 4 pieces to reduce those potential taxes. So it can be a nice mechanism to use on this.
Yep.
Lots of fun, interesting things on that aspect. What other things should we know about taxes for Americans in Belgium?
One of the kind of something I've run into that's a pretty good planning idea, and everything, you know, is always based upon your particular facts and circumstances. So, you know, certainly talk to an advisor on details. But you know, Belgium, just the way the system is set up, they tend to tax you very heavily while working. But then when you hit your retirement years, it's a pretty favorable tax system. You know, capital gains doesn't apply, pension distributions. So if you have like a Belgian pension account and you're in retirement and start taking those pension distributions, you're typically looking at only paying a 10 to 16% tax rate. So what can end up happening, you know, if you're an American there, in your working years, you've got plenty of foreign tax credits. You're not paying any residual taxes because of the high Belgian taxes. But then when you hit retirement, and if you remain in Belgium, it kind of flips on you, where the US is going to tax pension distributions at the ordinary graduated tax brackets, but Belgium taxes them at a much lower rate. So you can then get in the situation where you're actually owing a residual US tax liability. One of the things to consider is, you know, I know a lot of people use the foreign earned income exclusion to offset their wages so that it's not taxable for US purposes. It's a pretty simple, easy way to go. The one problem with the exclusion is when you exclude your foreign earned wages, you also have to exclude the foreign tax credits related to that. So basically you're excluding the Belgian taxes that you had paid on that income that got excluded. Well, something to think about, and the way foreign tax credits work in the US is so let's say you pay, you know, $100 of Belgian tax, and on that same income in the US, you would only pay, you know, $30 of US tax. Well, when you claim your credit, you use $30 of the credit, the remaining $70 becomes a foreign tax credit carry forward in your US return. And that credit can carry forward for up to 10 years. So that if you have lower taxes in the future, you can end up using those credits in the future. If you haven't used it within 10 years, then it just expires. A planning thing to consider is, you know, kind of as you're leading up to the retirement years, you know, in that 10-year window before retirement, you may want to consider not using or kind of revoking the foreign earned income exclusion, with the intention of being you actually want to grow your excess foreign tax credits. Now, obviously, you still want to kind of in the working years still not have a residual US tax, but if you can build up a foreign tax credit carry forward, you'll be able to use that in your retirement years when you start taking your pension distributions.
That's brilliant planning advice, because naturally a lot of people fall into changing categories between their working years and their retirement years, and being able to offset those credits gives them a great advantage versus the simplified FEIE.
Yeah, the one thing you want to be careful of is if you revoke that exclusion, you can't take it again for a period of years afterwards, for about 3 or 5 years. So if you are currently in Belgium, but then you decide that, hey, next I'm going to go work in Dubai where there's no tax, or Singapore, a really low tax rate country, then you would want to take the exclusion because you're not going to have any credits. So you do want to be a little bit cautious about what your, you know, you got to know what, to some degree, what your future plans are, because it locks you into some things for a few years to come.
Brilliant point. Brilliant point. What we're going to do is we're going to open this up to any questions that you have for Shannon. You can put those into the chat portion down on your main screen. We'll get to each of those. I'm going to just go through a few resources that you might want to be aware of, and we'll send these out afterwards. The first one is American Citizens Abroad. You've probably met Michael and Mary Louise as they've come and presented in Brussels at our past financial forums. Make sure to visit their website. They're an advocacy group, and Mary Louise is our lobbyist in Washington, D.C. So she's right there on the ground advocating for us. One of the big projects is residency-based taxation, which I'll get back to, but great resource for all of you. I'll let her introduce the entire organization.
Welcome, everyone. My name is Mary Louise Serrato, and I'm the Executive Director of ACA, American Citizens Abroad. I wanted to talk to you a little bit today about our organization. American Citizens Abroad has been advocating on behalf of Americans living and working overseas for over 40 years. We are nonpartisan, and we are a qualified 501c4 nonprofit organization based here in Washington, D.C. As part of our structure, we also have a educational and research branch of ACA called American Citizens Abroad Global Foundation, or ACA-GF, which is a 501c3. So a couple of things you should know about the organization. Being nonpartisan is very helpful to our advocacy work, because when we go up on the Hill and advocate for the issues facing Americans overseas, we have no political interest. And having two qualified nonprofits is very important, because the offices we're meeting with, the stakeholders that we're partnering with, they understand who we are, they understand our structure, and that is really important for credibility in advocacy work. So what are our issues? ACA has for over 40 years advocated on a wide range of issues affecting Americans overseas. Everything from citizenship, voting, taxation and compliance, and access to government services or programs such as Social Security, Medicare, even dealings with the US State Department. Had much success in being able to influence certain regulatory policy on things like FATCA.
Oh. Sorry about that. It seems like we had some technical difficulties right there. Okay, going from there, I apologize for that. We'll send along that video so that you can catch the last little part. A few other nice little resources. We have the American Expat Guide, which will give you 20-something pages of information covering PFIX and covering what kind of elections you want to make in your taxes and how you want to set up your investments. So a nice resource there. A little bit of information on why you want to keep from owning any PFIX, and we'll cover this in a second with Shannon of his views on PFIX, but that's an outside source. And if you need any professionals that work with predominantly US expats, you'll want to see the US Expat Directory, which lists different lawyers, accountants, financial professionals that work on each of these different subject areas. If you're looking for a financial advisor, make sure that they're US qualified, and you can find out all their background on Brokerage Accounts. So a great resource for you there. And the IRS website lists out all the double taxation treaties, including the United States Belgian tax treaty and how to interpret it. The last thing that I'll cover, and then I'll come back to Shannon. I'll ask him to turn his camera back on after I crash the whole system, is that we have now started a residency-based taxation coalition. This is ACA and AARO and several other firms, including mine, Dunhill Financial. We have built a coalition so that we can work together towards trying to achieve residency-based taxation. You can find out more information on that website, and other organizations will be joining. Naturally, we'll come back to the American Club of Brussels. Shannon, do you want to turn your video back on if you don't mind?
I think you might have to do it, Brian.
Okay, let's see.
It says the host.
There we go.
There we go.
You're back in there. I've never crashed Zoom before, but now I've done just about everything. Well, always entertaining. Perfect. So you ready for some questions, some unedited questions? We'll see.
Yeah, I see we've got a few in the queue, so fire away.
Exactly. We've got Eric Martin. He's asking, what about the individual exemption of $12,400? Do you think that will be reduced by Biden?
Yeah, so that is one of the kind of that increased standard deduction and the changes of the exemptions and credits, child tax credits was part of the Trump tax bill that had been passed. So if, again, if nothing happens, those will expire as of 2025. So it's gonna, the standard deduction is gonna drop back down, probably about half of what it was. What's a little bit interesting is none of that's a super straight answer on what it's going to mean to your actual ultimate tax outcome, because what they did was, so they doubled the standard deduction, but if you have kids, and if you're a single taxpayer or just a husband and wife with no kids, it's, just plan on that kind of reducing in half. Well, not even so much, because what they did is they took the exemptions away. So there used to be a standard deduction, and then there were separate exemptions for each person in the household. Well, they increased the standard deduction, but they took the exemptions away by about the same amount. So to some degree, it didn't have actually a huge net effect. They just kind of moved some pieces around. One of the things, with that increased standard deduction, you've got less people taking itemized deductions now, because one of the other provisions that they had done is they put a cap on the amount of state income taxes and real estate taxes that you can deduct. It used to be an unlimited amount. Now they've put a cap of $10,000 on that. So again, that piece would come out if there's if that current legislation expires and there's no changes. That's likely something that if Biden and Congress do come out with any new legislation, that's likely something that they would look at. Not to get too political with it, but that had a pretty heavy impact on Democratic states. So because when they took away, and this tends to be a little bit higher income earners, but when they took away or when they put that cap on your state income tax deductions, well, that has the most impact on states that you're paying a high tax rate in. That tends to be New York, California, well, basically both coasts. Your states like Florida, Texas, more Republican states don't have as high of state income taxes. So I'm not saying that was ever intended when they passed the law, but it did have a little bit of a political connotation, is that it had a pretty heavy impact on the Democratic states that had a higher state tax rates. So I could see them wanting to do something about that itemized deduction on the state taxes. Doesn't impact as much once you're overseas, because you may not be paying a state income tax, but that's an area that Congress is going to want to look at to make some changes.
Brilliant point. Heidi is asking, what if there are separate accounts at the same bank? I'm assuming she's meaning back for the wealth tax if you have multiple accounts. So I think this was more what I was talking about, was that if you split the accounts and stay under $1 million, then it doesn't count. From how I've read the actual agreement, essentially it needs to be at different institutions. You can't just divide it in the same institution. So that doesn't help you in that way. Carrie asks, if you moved abroad for work or school, but own a home in the United States, if you sell the US home, are you subject to capital gains tax? What if you lived abroad for a couple of years before selling?
Okay, so a sale of a house in the US, it's subject to capital gains tax also. But there's a special provision for personal residences where you can exclude up to $250,000 of gain per taxpayer. So that's typically what I see happen with individuals, is that they sell their personal home. It's subject to a capital gains tax, but then they can claim an exemption that, unless you have a really, really expensive house with a huge gain, you generally don't end up having to pay a tax on it. The key to qualify for that exemption is you have to have lived in the house as your primary residence during at least 2 of the past 5 tax years. So if you sell your house right after you move to Belgium, you're easily going to meet that condition because you've been living in it, in theory, at least 2 out of the last 5 years. You'd meet that, you can take the gain exclusion. What you need to be careful of is if you hold on to that house for several years after you left the US. as long as you're still within that 5-year window that you can look back. So for example, if you've moved to Belgium and 2 years later you sell the house, you can still look back on the previous 5 years and claim the gain exclusion. If it's been 7 years though, and then you try to look back, you're not going to be able to, because you weren't living in that house within the last 2 of 5 years.
That's a brilliant point. And the other part that you need to add to that level is when you buy on the other side. We've had a good decade where the dollar has been going up, and so we haven't had to worry about large gains on foreign properties. But now, as we've seen the dollar going down since August, we need to start thinking about our foreign properties and how they'll get hit with US capital gains, especially fictitious ones, when the value of the property remains the same, but the value in dollar terms could change in a large amount over the course of several years.
Yeah.
So a
couple other pitfalls you want to watch out for is if you rent your house while you're living in Belgium, so it was your primary residence, but you've been renting it out for the last couple of years, that kind of changes the use of the property. You can still potentially claim a gain exclusion, but there's some pretty specific facts there, and gets into some proration stuff. So that's a scenario that you certainly want to talk through with an advisor, because it gets pretty detailed on that. One other thing I'm going to mention is if you buy, if you buy foreign property, so let's say you buy a house in Belgium and you have a U.S. bank is probably not going to loan you money on that, so you're likely getting that loan through a Belgian bank, and a loan denominated in euros. You can have currency exchange rate gains or losses on the payoff of that loan when you sell the property. And the U.S. tax system is not always very fair. So if you have a loss on the currency exchange rate, basically it takes you more, in relative terms, it takes you more US dollars to pay that off just due to the exchange rates changes. That loss is not deductible. But if you have a currency exchange rate gain on the payoff of that mortgage, the gain is taxable. So not a fair system, but that's just what their rule is. If like your monthly payments that you make, just regular payments, it doesn't apply to those. It's generally just if you have a lump sum payment, which is most commonly at the time that you sell the property and pay off the remainder of your mortgage.
Feels grossly unfair, Shannon.
Yeah, it very is. That's one that shocks people a lot of times, because it's and that applies even if you lost money when you sold your house, but if you've got a currency gain, you still pay tax on that gain.
Completely. It's grossly unfair. What about Belgian Social Security and US taxes? This is from James. He read the tax treaty between the US and Belgium, and that the Belgian Social Security was US tax exempt.
Yeah, so when you're talking treaties between countries, there's generally 3 different types of treaties. There's an income tax treaty that just covers income taxes. There is a Social Security agreement, which is commonly, or kind of the name of them is they're called a totalization agreement. That covers your social taxes. And then there's separate treaties that cover estate and inheritance taxes. So the US and Belgium do have both income tax treaties and a totalization agreement covering Social Security. The US does not have an estate tax treaty with Belgium. So that's a tough one, because you could potentially be subject to double estate taxation. On the Social Security agreement, the way that works is basically it prevents you from paying Social Security taxes in both jurisdictions. So if you're kind of have gone over to Belgium on an assignment and you are remained on a US employment contract, and your employer obtained what they call a certificate of coverage for you, effectively what that does is that keeps you on US Social Security system, and you're exempt from the Belgian system. And that can be automatic up to 5 years. You can possibly get a 2-year extension. If you've got one of those, that's probably something that you've talked through with your employer, because your employer would have been applying for it. If you're on a local Belgian employment contract, then you're going to be subject to Belgian Social Security. and exempt from US Social Security. And it works the same even if you're a self-employed individual. So if you're self-employed, normally you'd be subject to US self-employment taxes. That's basically Social Security for a self-employed individual. But if you're subject to social taxes in Belgium, then you're exempt from US self-employment tax.
It's almost like you saw the next question, because Heidi's asking, what are the implications of owning one's own business in Belgium?
Okay, and that's kind of one of those loaded questions that can go a lot of different ways. You know, my first comment is certainly talk to a Belgian specialist about kind of the Belgian tax rules. I know the Belgian system pretty good, but I'm not of the skill set level to completely advise you on how to set up a business in Belgium. From a US perspective, if you're just a self-employed individual working kind of in your own name, that's pretty clean. It's basically kind of functions the same as if you were a self-employed person in the US. You've got to, the US applies worldwide taxation. So all of that self-employment earnings is going to be taxable in the US and calculated under US laws. So if you have assets that you're taking depreciation on, you calculate that depreciation under US laws. But at the end of the day, you report the income, you take a credit for the taxes paid to Belgium. If that's higher, in theory, you pay no residual US tax. And if you were subject to Belgian self-employment or Social Security taxes, US self-employment tax doesn't apply. If you try to do that business through a company in Belgium, so you want to go establish either a company or a partnership. So, if you establish like an SA or a BVBA, that makes it vastly more complicated because a US person that owns, there's kind of different tiers, but effectively, if you've got at least more than 10% in a Belgian company, you effectively create US reporting requirements for that Belgian company. So you have to file it's essentially an additional like corporate or partnership tax return in as part of your individual return. So before you go down that route, certainly talk to a qualified advisor in that area. And I can help with that, or otherwise I have some good colleagues in some US based colleagues in Brussels still that do advice on corporate taxes. So they deal with this every day. But that's a very messy area that you can get into, because one of the problems that you can have is, especially if you're like doing services through your Belgian company, you end up having to recognize the income. You don't get a deferral of the income. So you have to recognize the income for US purposes, but the taxes are considered paid by the company, which is a different entity. So you may not be able to claim a credit for the taxes that were paid. There is an ability you can make an election from a US perspective to treat that as a disregarded entity. That fixes some of those problems, but you still have to do reporting for it. And it's got to be done within certain time windows. So my suggestion is before you actually do any of that stuff, talk to somebody to make sure that you get it structured correctly. Most
definitely. That's always the important part, because otherwise you end up with problems that linger for years. With somebody that is actually having to set themselves up for joint taxes in Belgium because they're cohabitating, can they make a different election on their US taxes?
Yeah, the US taxes is going to be based upon kind of whatever elections you want to make for US purposes. It's not contingent upon in Belgium. Now, the filing status is going to look at your legal marital structure. So if you're legally married in the US, you're either going to be filing joint or married filing separately. Now, cohabitation, that's kind of where you want to look at it from the legal perspective. If you want to evaluate under US law whether you're legally considered married or not. If you're literally just cohabitating, that may be considered a joint possibility within Belgium, but the US is not going to consider that joint unless you're legally married. The US does have one interesting rule that if you are married to a non-resident alien, so let's say that your spouse is Belgian, you're legally married, but spouse is Belgian, does not have any US citizenship and does not have a US green card, Normally in that scenario, you'd have to do either filing separately, or the husband's got to make an election to be treated as a U.S. taxpayer to file joint. If you have a U.S. qualified dependent child, though, so meaning, let's say you had children and at least one of your kids has U.S. citizenship, you can actually use the head of household filing status, even though you're legally married, and that's because your spouse is not a U.S. taxpayer. So
Brilliant.
Kind of a special quirk in there.
I'm going to ask a self-serving question for financial planning. What are your views on PFICs in the QEF election? First, you want to define PFICs in the QEF election, and what are your views on it versus using other instruments?
So a PFIC that stands for Passive Foreign Investment Company. And the law was created for, I would say, maybe good intention, but pulled probably a lot of unintended things into it that creates havoc for people. The concept is that the government didn't want people to establish a company sitting outside the US in a tax-free jurisdiction and put all of their investment assets in that company and then do their investing from that foreign company in order to be able to avoid US taxation. So that's kind of the basic concept of why they did this. The way the laws are written is you meet the conditions to be a PFIC if that's a foreign company and at least more than 75% of its assets are investments in other companies. So if you're just doing you've established a business in Belgium and you're doing an operating, making widgets out of that company, generally you're not going to have any problems with the PFICs. Where people run into them is in the mutual fund context. Because if you buy like a Belgian CCAV or a mutual fund on the Belgian market, that is in effect a company that has investments in a bunch of other companies, strictly for investment purposes, but it meets the definition of PFIC. So it gets subjected to this different tax regime system. And effectively, in a short answer, it's a very unfavorable system. You do get a deferral of the taxation, but anytime you take a distribution from that account, you pay tax at the top ordinary rate, and it doesn't even matter what bracket you happen to fall in. You're just going to be paying tax at the top bracket, and you pay a 7% interest charge over the entire life that you've held that PFIC. So effectively, they get to be very, very expensive. There's some ways that's the default tax treatment with them. There's some ways to avoid that. One of them being the QEF election, qualified electing fund. Another one that I commonly see is the mark-to-market election. Qualified electing fund is basically, or QEF, that's basically where you make an election to treat it as an ordinary US investment account. So you recognize the annual earnings, dividends, capital gains if there's sales of it, interest, and you just pay regular US taxes on those as if that was like a US based investment. The problem with the QEF election is if you can get the information to be able to do the election. And that's where we generally see the problem is again, you're dealing with a foreign investment company that really doesn't care about the US system, and they typically don't want to comply with giving you the information that you need to be able to make the QEF election. So that's kind of the practical issue. I mean, in theory, it's great, but the practical issue I see typically come up is you just can't get the information to be able to make the election you need to.
And a lot of times it becomes a little bit more expensive to do so than just leaving your investments in the States, leaving them simple in those formats. So
the other option, the mark-to-market election, that's where basically you make an election where every year you tax the appreciation or change in value of that account. So start of the year, I compare my balance at the start of the year to the value at the end of the year, pay an annual tax on that. But again, it's not a great investment structure because you're accelerating the taxation of that and paying tax on something that you may not have a cash distribution from.
And you're not getting to offset those years the market's down. We promise every client that 3 out of every 10 years, the markets are going to go down, and you don't get to offset that in any way, shape, or form.
Yeah.
And
there's likely no foreign tax credit because the foreign jurisdiction's not applying a tax because in their laws, it may not currently be taxable.
Exactly.
Simplest answer, and this is where Brian can help you out, is figure out how to hold those investments through a U.S. brokerage account.
Exactly. When back in the days when we used to be able to do these events in person, and Dave DeRuyter would normally host us over at ING, and they don't offer investments for Americans, and it's the best favor that they can do for Americans. They can take care of the mortgages, the savings accounts, the checking accounts, everything else. But this is why they don't want to offer those services to Americans, because then they end up getting on Shannon's desk and he goes, "Why would you do it this way? That's going to cost you a lot more in taxes."
Yep.
So if you're struggling with getting a Belgian bank to help you on your investments, this is the reason why. This is why you want to go to an American expat specialist and the likes. We're running out of time here. We have a couple quick questions here at the end. Let's see. Carrie says, do you know U.S. brokerage accounts that still allow investments from non-U.S. residents? We were notified that we can no longer contribute to ours. I'll pull this one because that's my field. There's several firms that still allow us to use Belgium. We use Trade PMR for a lot of our clients. Interactive Brokers is another good one, and Premium is one of the international ones that we utilize. Other institutions will use some other firms. A lot of the companies in the US don't want to share their licensing between the US and Europe. And that is why they're asking to close those accounts down, because they shouldn't be soliciting across borders. We happen to be registered both in Europe and the United States. So that is why we're able to do those and use those through those brokerage channels. So the best means is to find those lists. Trade PMR, Interactive Brokers, and Premium are the three that we utilize. Let's see if we can get one more. Diana, where can I seek financial advice for investments for U.S. expats on the go? I understand it's nearly impossible. Okay. Well, Diana, this is exactly what my company does. We have tons of webinars on our YouTube channel. We'll be adding some also to the American Club of Brussels YouTube channel. And you'll be able to see our entire process and the 7 questions that you want to ask every single American expat financial advisor. So you can go to Dunhill Financial on YouTube and you can find those. And otherwise, we'll be sending up a follow-up email after this, which will include Shannon's information, my information, the link to this YouTube. I know there's some questions that we didn't get to on this because we are running a little bit short on time. So I apologize for that. But what I'll do is I'll provide all of these questions over to Shannon so that he can reach out to anyone after this webinar. And otherwise, Shannon, are you all right with them reaching out to you?
Yep, that's perfectly fine.
Perfect. We'll be doing some more of these types of events, but if you haven't seen them, go to the New American Club of Brussels website. The board of directors, which several of them are on this call, have been doing an amazing job of revamping the newsletter, revamping the website, so it's worth seeing. There's some interesting events coming up. One is mushroom hunting, scrumptious fungus, aka mushroom hunting, on February 22nd, and a couple of visits to the Library of the Duke of Burgundy on March 27th. It looks like it's a 2-part visit. So make sure you check those out on the events. Still, even with the online events, we're able to do these wonderful things with individuals like Shannon. So Shannon, thank you for joining us. Thank you for joining back with the club. And we look forward to seeing you in Brussels sometime soon when they allow us to all get over.
Yeah, I'm looking forward to it as well once we can travel again.
Brilliant. Well, unless you have anything else to say, Shannon, I'd like to thank everybody for joining us, and we will see you all soon.
All right. Take care, everyone.